Right now we're looking at an option strategy that will, no matter what, if you can enter, you will make money. Now the hardest part about this is entering. We're playing we're trying to get an advantage on the market makers. We're trying to get an advantage in our order entry. So the main idea with this is that it will only work if your order is small. So I'm saying, like, we're doing options. So one spread. Don't try to get gutsy and say, you know what, since no matter what I'm going to make money if I enter in this trade, I'm going to trade 1,000 spreads. It won't work because you need 1,000 people that are willing to get ripped off, or 1,000 contracts that are willing to be sold at a bad price. You're trying to get it at a good price. So what we are doing a butterfly spread. So say for instance, here, this is the one that I want to do these spreads on because it's so darn volatile. We have the VIX, the volatility fear index per se, and you see, like, even today moved 10%, yesterday moved like 4%, day before moved nearly another 8%. It has wild swings. So options always trade at a premium. So we go over here, take a look at the VIX, and we want to be trading what's called a butterfly spread. And I'll get rid of these to clear some space up. So I enter the VIX, I look for a butterfly spread, and what you do, you try to get a theoretical price model, which is available in Thinkorswim, or you can use an online option pricing calculator. You want that, the bid, and the ask. Now, you're seeing the difference between these, the bid and the ask price. They're huge. A 25-cent negative to a 50-cent positive. We want to be buying these at a credit, which means that basically we're getting paid to buy these option spreads. So this is, I'm going down here looking at the theoretical price. I see 3 cents. Nah, I don't want that. You look for the one that has the lowest, and by lowest I mean most negative theoretical price. So say I'm looking, alright, lowest one is negative 6 cents. So that means with reasonable confidence, I think I can get in at a 5-cent credit. So I'm going to buy the butterfly, which is a butterfly is basically where you sell 2 out of the money calls and then one at the money call. Oh wait, take that back. Here, take a look at this bottom area here. You buy the $32.50 call, you sell 2 $35 calls, and you buy one $37.50 call. And say I'm just going to do one of these spreads at a 5-cent credit. And we go to our probability analysis. We set the probabilities to our break even, and you can do any expiration month that you can get a good price in, because no matter what, you're going to make money. Now, of course, say if you go really far out in time, you're going to get tired because your money's going to be tied up. But still, you're getting paid for this, so you're barely tied up in a sense, since we're only spending like $0 on the trade. Okay, so our break even. And actually, our break even here, I'm going to compress this scale at the bottom. No matter where the price goes, we make money. 100% success. If it goes, like say with this option, we bought it at a $5 credit. We got paid $5 to buy this. No matter what happens to the stock price, we're going to make $5. But there's a little golden light in here. If the VIX on options expiration day, so the third Friday in August, is anywhere between 32.50 and 37.50, we're going to make a lot more. Actually, if it lands right at $35 on this trade, we'll make over $250. So it's basically 100% chance of making money, and after commission, I'll even include the commission, we would lose $1. But is $1 a big problem? Actually, here, let's take a look. What's our probability of it winding up between here and here in this big money area here where we make a lot? Not that good. We have a 1.31% chance of it being there on options expiration. But hey, for $1 to get, let's see, yeah, it's basically the odds are, I mean, we're getting a payout of 1 to 250, so I'll take it. Now what you can do, you can take advantage of option mispricing. So when there's a big earnings gap, that is when the option prices are all over the place. So say for instance, like we go back to Cisco and we go to the 6-month chart. Look at this day. Cisco went down nearly, it went over 10% down. At the very opening bell, you think that all the traders are standing by with their calculators saying this is going to be the exact price that this option should be trading at. No. There's a lot of orders that are going to be stop market orders, which means that option traders will take any price that they can get. At this point, you want to get in your order, you want to get it in at your credit, and you want to, in all honesty, you want to take advantage of someone else. Alright, so there's 100% chance. The hardest part's actually getting into the trade. So what I did, I actually just filled out 4 butterfly spreads for the VIX tonight. And if any of them get filled, hey, I'll be happy. If they don't, oh well, there's always another chance. Alright, thanks for watching. If you have any questions, post in the comment box.